In this video, we're covering a powerful strategy that could save you money on your taxes: tax loss harvesting. By the end of this video, you'll know exactly what tax loss harvesting is, how it works in detail, and how to use harvested losses to offset taxes and keep more money in your pocket. So what is tax loss harvesting? It's a strategy where investors sell investments that have lost value. By selling at a loss, you harvest that loss, which then can offset taxes on other investments that have gained value. This reduces the overall tax owed, especially on short-term gains, which are taxed at a much higher rate than long-term gains. Now here's why it matters. If you have investments that have grown in value, selling those investments triggers capital gains taxes. Tax loss harvesting is a way to lower or even eliminate those capital gains taxes by balancing them out with losses. In short, it's about using losses to reduce your tax bill. So how does tax loss harvesting work? Let's go through a step-by-step process. First, it identifies investments at a loss. It goes through your portfolio to find investments that are currently worth less than what you paid for them. And these are the losses that you'll want to harvest by selling. Selling these investments locks in the loss, which creates a harvested loss that can then be used to offset your taxable gains. Remember, this harvested loss is now available as a tool to reduce your taxes. And here's where tax loss harvesting preserves your portfolio balance. After you sell the losing investment, you can buy a similar, not identical, investment to keep your portfolio's balance and exposure the same. This helps avoid the wash sale rule, which we'll cover next. When you sell an investment at a loss, the IRS has a rule called the wash sale rule. This rule says you cannot buy the exact same or a substantially identical investment within 30 days before or after the sale. If you do, the tax benefits from that harvested loss disappear. So here's how to avoid the wash sale rule. If you sell one S&P 500 ETF at a loss, for example, you can replace it with a different S&P 500 ETF from another provider. This keeps you invested in the same type of asset without buying the identical fund. So you still capture any market gains without triggering the wash sale rule. Now that you've harvested losses, here's how they save you money come tax season. You can offset capital gains. When you sell investments at a gain, those gains are taxable. If you harvested losses, you can apply those losses directly against your gains. Here's how it works. Say you have $10,000 in capital gains for the year, but also have harvested $5,000 in losses. You'd only pay taxes on the remaining $5,000 of gains, reducing your tax bill significantly. It's also essential to know that short-term gains or gains on investments held less than a year are taxed at a higher rate than long-term gains. The IRS allows you to offset short-term gains first with short-term losses, which reduces the amount taxed at higher short-term rates. Then, you can offset long-term gains with long-term losses. This maximizes the tax benefits of your harvested losses. Now, what if your harvested losses are more than your capital gains? Well, the IRS allows you to apply up to $3,000 of those losses against your regular income each year. This is especially beneficial if you don't have enough capital gains to offset. So say you're in a 37% tax bracket. Applying $3,000 of losses would save you about $1,100 in taxes on your regular income. Finally, if you have more losses than you can use in a single year, you can carry them forward to offset gains or income in future years. So let's say you harvested $10,000 in losses, but you only had $3,000 in gains this year. After applying $3,000 to reduce your income, you'd still have $4,000 left over. You can carry that forward indefinitely, giving you a bank of losses to use in future years. Let's go through a detailed example. Imagine you invested $20,000 in an ETF, but it dropped to $18,000, leaving you with a $2,000 loss. If you sell this ETF, you'll have a harvested loss of $2,000. Now, let's say you also sold another ETF with a $2,000 gain. Normally, you'd owe capital gains taxes on that $2,000 profit, but because of tax loss harvesting, the $2,000 loss cancels out the $2,000 gain, so you pay no taxes on that gain. Now let's say you had $4,000 in harvested losses and $2,000 in gains. You'd still have $2,000 in losses left, which you could apply to your regular income or carry forward to the next year. All right, let's go through some tips for getting the most out of tax loss harvesting. Look for daily opportunities to harvest losses. not just at year end. Some investment platforms monitor for tax loss harvesting every day, which increases your total harvested losses over time. When replacing an investment, choose a similar but not identical asset. For instance, if you sell one large cap ETF, replace it with another that tracks a similar index to stay compliant with the wash sale rule. Consider the platform fees. While tax loss harvesting can offset your gains, some platforms charge advisory fees that might reduce the overall benefit. Make sure that your savings from tax loss harvesting exceed any platform fees. And that's tax loss harvesting in depth. It's a strategy that, when used wisely, can help reduce your taxes and keep your portfolio balanced. Look for a service that offers automated tax loss harvesting if you want to take advantage of this strategy, and make sure it aligns with your long-term goals. If you're interested in learning more, head over to range.com. Thanks for watching. See you next time.